Okay, we're going to begin delving into Chapter 4, which is a discussion of consolidated financial statements. Surprise, surprise. And now outside ownership, which means, and it's another way of saying it, we have a parent who buys a subsidiary, gets a controlling interest, but fails to get 100% ownership. We could say fails to get it, or we could say it's just by design. They purchased something less than 100% because they didn't want 100%, maybe. Whatever the reason, instead of buying 100%, they buy something less, but it's greater than a percentage, whatever that is, to gain control. So we know it when we see it. We learned that early on in the course. We know control when we see it. Okay, so here's the situation. When there is this less than 100% ownership, we call that the existence of the other shareholders of the subsidiary, whatever that percentage is, that's not owned by the parent, we call that the non-controlling interest. All right, bullet number 1 is probably true. Most parent companies do possess 100% ownership. But if it doesn't, what happens then? Who owns the rest? Non-controlling shareholders. So we have two sets of populations of shareholders. The shareholders of the parent, vis-a-vis the parent owning whatever percentage it owns of the subsidiary, and the other shareholders owning the remaining percentage. It could be made up of one shareholder or many, many, many shareholders of this non-controlling interest portion of the ownership of the subsidiary. So it would break down to one owner owning the controlling interest, that's the parent, and indirectly all the shareholders of the parent own that percentage, but only through the parent. And the non-controlling interest is owned by however many shareholders there may be owning the non-controlling interest percentages of the subsidiary. Now, when the parent has control, we say that we're going to reflect the consolidated statements showing what the parent controls. Parent controls all of the assets and all the liabilities of the subsidiary, even though it doesn't own 100%. But the theory of showing what the parent controls in the consolidated financial statements means that we are going to show 100% of the subsidiary's assets and liabilities, even though the parent doesn't own 100%. It controls 100%, show 100%. See something, say something. Oh, it's wrong tape, wrong recording. Since we're going to show 100% of the assets and liabilities, we're going to show 100% of the income and expenses. Again, it's what the parent controls. But since there's a non-controlling interest, the consolidated financial statements are going to want to differentiate the amount that belongs to the non-controlling interest shareholders versus the controlling interest. So on the balance sheet in the equity section, we'll have a non-controlling interest equity. And in the income statement or on the income statement, we'll have a non-controlling interest net income of the subsidiary or of the consolidated total as it really is. Okay, describe the valuation principles using the acquisition method of accounting when we have a non-controlling interest. So let's set the stage. Again, the parent must consolidate 100%, even though it's not a full 100% ownership. We're going to value the subsidiary at the acquisition date based on what we know to be the fair value of the respective portions, the controlling interest portion and the fair value of the non-controlling interest portion at the acquisition date. That's bullets, the last two bullets on the slide. So the book up is going to be at 100%, but based on the fair value that the parent pays for its controlling interest versus the fair value of the non-controlling interest at the acquisition date. So let's see an example. Shall we? Okay, we shall. Parker Corporation wants to acquire 90% of Strong Corporation, and does. But to do so, it paid a premium for the shares. So it paid $70 per share when we know from the marketplace that Strong stock has been trading for $60 per share. Parker pays the control premium to get 90%, and then they stop acquiring more shares. They're satisfied to own 90%. How do we now value the 10% that Parker did not purchase that still remains in the ownership of non-controlling shareholders? How do we do that? See if you can answer the question. All right, so the way we'll do it is, let's say that it was 10,000 shares outstanding. Parker purchased 9,000 of them to get 90%. They paid $70 per share, or $630,000 total. The remaining 1,000 shares not owned by Parker, Parker doesn't want them, so the value has to revert back to what we know, and we do know there's a market value, because we're told there is, $60 per share. That's the value of the non-controlling interest. That's all they could get. Parker's got its 90% at the date of acquisition. The non-controlling shareholders are left with saying that their value of their stock is only $60 per share, or $60,000 for the 1,000 shares. Hence, total value of the subsidiary. In the book up, in this fair value acquisition date method, where we take advantage of this purchase to book up the assets and liabilities to their fair value, it's $690,000. $630,000 for the controlling portion, $60,000 for the non-controlling. So how do we allocate goodwill? Let's see what happens. In this same example, we're going to be told that the identifiable net assets, meaning the fair value of the assets and the fair value of the liabilities, comes out to equal, for 10,000 shares of the subsidiary, what the market value was paying. It just happens that it's telling us that. It doesn't have to be, but it's telling us this is the case. And that means that the total value of the identifiable net assets is $600,000, 10,000 shares times $60 per share. The parent, remember, paid $630,000 for 90%. 90% of $60 per share would have been, or 9,000 shares at $60 per share, would have been $540,000. This is paragraph 2. So what the parent paid $630,000 for was $630,000 above the identifiable net assets, which totaled $540,000. Hence, there's $90,000 of goodwill, and the goodwill here, in this case, will belong solely to the parent, because the non-controlling interest shares at $60 per share represents the value of the identifiable net assets with no goodwill. $60 per share for 1,000 shares is $60,000, and that's what it's worth with no goodwill added. Just so you can see it, here's the example laid out nicely for you. Total acquisition date fair value we saw, based on $630,000 for the premium paid by the parent, $60,000 for the non-controlling interest, left holding it at $60 value per share, $690,000. The fair value of all the assets, net of the liabilities, is $600,000, goodwill $90,000, and we allocate that goodwill as you see here. It belongs to the parent. After all, the parent paid for the goodwill. The remaining shares, the 1,000 shares, has no goodwill assigned to it, because there is no goodwill based on what we know the value of those shares to be. In theory, with this problem, had the parent, Parker, said, we now want to buy the remaining 10% of the shares, they would have only had to pay $60 per share. Because at the time they gained control, they were satisfied and they were no longer pushing the market with a premium, and so therefore the rest of the shares go back to the fair value on the trading market, $60 per share. All right, that's the theory of what's being told to us. And these are facts. These are not things that we are computing. These are facts. We do compute the goodwill here. Pardon me. We do compute the goodwill, as you see. And we go to the next example, say, what if there was no active market at the time of the purchase for 90%? No active market means we could only go on what we know, and we'd have to assume that the remaining 1,000 shares held by the non-controlling interest is valued at $70 per share. And now we would value the subsidiary at its total implied value for 10,000 shares at $70 per share, or $700,000. Now we know that the identifiable net assets are only worth $600 for the total of the subsidiary. So look what you've got now. You've got an implied value. We're going to do a book up for everybody, including the non-controlling interest, to $700 total, $70,000 for the non-controlling interest shares and $630 for the controlling interest shares, total value $700. But the value of the identifiable net assets is only $600. So now you know that we're looking for $100,000 of goodwill, because that's how we do goodwill. It's the residual method. And there you see how we will allocate the goodwill at this point. We'll allocate it $90,000 to the controlling interest as was done before, but now $10,000 belongs to the non-controlling interest. Makes sense because the non-controlling interest is valued in this second part of the study, a new example where there's no readily known market value, so we have to use what was paid by the parent at arm's length, the $70 per share. And we know that the identifiable net asset value is only $60 per share. That's what we're told. So the difference, 60 from the $70 fair value, must represent goodwill. $10 per share times 1,000 shares, 10,000 goodwill to the non-controlling interest. All right, that's cool, real cool. Let's pause here and we'll pick it up at the next go around.